This is Trade Alive with IUX, where markets come alive and trading gets real. Let's go live.
This podcast is brought to you by IUX Trading Platform, elevating your trading experience.
In the financial markets, many participants spend a significant amount of time searching for an external solution. They scan thousands of charts, evaluate mathematical models, and transition between various indicators, all in pursuit of an external framework to optimize their market decisions. However, there is a structured school of thought among experienced market operators who understand a different dimension of market architecture. They recognize that long-term trading sustainability relies heavily on the internal psychological framework and risk parameters established by the operator. Dr. Venkat Tharp's work serves as a widely studied educational case in analyzing this internal landscape. He was not a traditional Wall Street trader, nor did he begin his journey as an institutional insider. He was a researcher, a PhD in psychology, who faced significant financial drawdowns during his early capital market operations. Instead of abandoning his research, he applied a rigorous process of behavioral analysis to his own trading outcomes. He formulated a perspective that challenges common assumptions. You do not trade the markets directly, you trade your subjective beliefs about the markets. Welcome to Trader's Journey, a part of Trade Alive, brought to you by IUX Education and IUX Markets. Before we delve into our case study today, please note this important regulatory disclosure. Trading forex exchange, or forex, and contracts for difference, or CFDs, involves a high level of risk and is speculative in nature. CFDs are complex financial instruments that come with a high risk of losing money rapidly due to leverage. In fact, 76% of retail investor accounts lose money when trading CFDs with this provider. You should carefully consider whether you understand how CFDs work, whether you can afford to take the high risk of losing your money, and whether leverage trading matches your financial objectives. In this episode, we will look at the comprehensive educational case study of Dr. Venkat Tharp. We will explore his systematic framework of TharpThink, examine the structural mathematics of R multiplies, and review the position sizing concepts designed to help market participants manage risk with professional objectivity. To understand the operational framework developed by Dr. Venkat Tharp, it is helpful to look at the environment where his methodology was first conceived. In the mid-70s, Tharp earned his PhD in psychology. With a background rooted in empirical research, he initially assumed that capital market participation could be managed entirely through logical and quantitative deduction. However, his early market execution resulted in notable capital drawdowns. He observed that he was susceptible to the same cognitive biases that frequently impact retail accounts, including loss aversion, emotional attachment to declining assets, and inconsistent execution. As a trained behavioral scientist, Tharp concluded that these negative outcomes were not merely the result of chaotic market conditions, but rather reflected an internal inconsistency in decision-making under stress. Through this meticulous analysis of behavioral data, Tharp identified what he called the Holy Grail myth. He noted that a large percentage of market participants search exclusively for external indicators of perfect entry signals, believing these tools guarantee future performance. Tharp's observation suggested a different structural dynamic. His framework placed heavy emphasis on three core components: psychological discipline, systematic position sizing, and entry strategies. By shifting the primary focus from chart patterns to internal behavior controls, he transitioned into a recognized architect of market psychology. Once Dr. Venkat Tharp recognized the impact of human behavior on capital preservation, he sought a systematic method to standardize execution. This led to establishment of the Van Tharp Institute and the integration of a methodology known as TharpThink. Within this discipline framework, Tharp introduced a structured mathematical concept designed to help operators manage performance data objectively, the R multiple system. While many retail accounts evaluate operations solely based on nominal currency values or percentage returns, Tharp observed that this approach often triggers emotional reactions. To counter this, he defined a standardized unit of risk denoted as R. R represents the initial risk, the exact amount of capital an operator predefines as the maximum acceptable loss if a position triggers a stop loss. For example, if a participant limits their risk on a single trade to a specific capital threshold, that threshold represents 1R. Under the rules of R multiple framework, the evaluation of performance becomes strictly systematic. Every controlled loss is aimed to be kept within the predefined 1R threshold. Winning outcomes are managed to capture multiples of that initial risk, such as 3R, 5R, or higher, depending on market trends. By viewing performance through abstract R units rather than immediate monetary gains or losses, the operator's focus shifts towards statistical consistency. This framework demonstrates that a system does not require an exceptionally high win rate to remain viable over time, provided that losing trades are strictly contained and winning trades effectively capture structural market movements. Within Dr. Van K. Tharp's strategic framework, identifying a specific market entry setup represents only a single variable in the overall operational equation. According to his methodology, the structural survival of a portfolio depends heavily on a critical parameter known as position sizing. Tharp defined position sizing as the component of a trading system that addresses the fundamental operational question, how much? How many shares, contracts, or units should be allocated to an individual position relative to total capital? To illustrate the importance of this concept, Tharp utilized advanced computer models to run algorithmic simulations. In these studies, a system was programmed to execute market entries completely at random, utilizing a statistical random entry simulation to eliminate predictive bias. The data from these simulations provided an interesting insight. Even without a predictive entry methodology, a portfolio could maintain structural stability and achieve positive performance over time, provided it was governed by strict exit protocols and a precise position sizing model. By dynamically adjusting allocation based on market volatility and total portfolio value, this approach is designed to protect the capital base during adverse conditions while allowing for systematic compounding. Many observers assume that maintaining performance in the financial markets requires enduring extreme psychological stress through sheer willpower. Tharp's research, however, suggested a more structured alternative, which became codified as his peak performance protocol. Tharp maintained that a trading system can only be executed as effectively as the person operating it. During periods of extended market corrections or consecutive losses, participants frequently experience heightened cognitive stress, which can lead to behavioral errors such as impulsive execution or risk management. To address this challenge, Tharp's protocol treats market operations with the discipline of professional athletics. He argued that an operator's mental clarity and emotional stability are primary components of risk management. His defense protocol dictates that if a participant's psychological baseline drops below optimal levels due to external stress or capital drawdowns, a predefined defense sequence must be initiated. Under these strict guidelines, the operator does not attempt to fight market conditions. Instead, they systematically reduce their position sizing parameters or temporarily liquidate active positions to hold cash. This protective measure is intended to help preserve both financial principle and psychological capital until conditions stabilize. The historical research of Dr. Van K. Tharp offers an educational case study in systematic market analysis and risk management. Through his publications, lectures, and behavioral assessment frameworks, he provided structured methodologies that have been referenced by institutional fund managers and individual market participants across various market environments. His core concepts suggest that achieving long-term consistency in the financial markets involves developing a disciplined internal process, understanding human behavior, and applying strict risk architectures. As we conclude this educational case study, It provides an opportunity to review your own market analysis and risk management protocols. Are you focusing primarily on finding external indicators? Or are you ready to refine your internal risk parameters and systematically evaluate your position sizing models? Share your perspectives and your risk management strategies in the comments below. Let us know how you approach risk tracking and capital preservation in your own operational framework. For additional educational resources on market structure and risk management concepts, visit our IUX website. IUX provides comprehensive educational materials to help you study the mechanics of trend analysis, observe price contraction patterns, and learn more about position sizing models in various market environments. Before we conclude, we must emphasize a critical operational reality. Trading and investing in the financial markets involve a high degree of risk and may not be suitable for all individuals. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 76% of retail investor accounts lose money when trading CFDs with this provider. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. The material presented here is strictly for general educational and informational purposes and should never be construed as direct financial, investment, legal, or tax advice. We're not recommending, soliciting, or endorsing any specific trading strategy, investment vehicle, or broker. Always execute your own due diligence, consult with qualified financial professionals, and rigorously manage your capital risk with proper position sizing and stop-loss protocols. Maintain your operational discipline, manage your risk parameters, and goodbye.
You've been listening to Trade Alive with IUX. Ready to put these insights into action? IUX is here to power your next winning trade.